You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Tuesday, 11 August. We've got local unemployment data due 11:30 this morning. I'm Simon Brown, coming at you live and loud from the Moneyweb Global Headquarters in Johannesburg, South Africa. On the show today, Bradfield. He's from Sharenet. I want to go back to Friday. Those US job data numbers are poorer than expected, which the market liked. Bad news is good news story. And the Spur update, quickly touch on that. They've got an adjusted Heps because they've got a arbitration they lost. But I got to say, I didn't think we were eating out so much. Maarten Ackerman from Cam Asset Management, the long-tail impact of the war in Iran, and chatting with Satrix and why chasing famous names probably hurts in the long term. This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines at Moneyweb. The banks that have beaten Capitec over 5 years. And Business Day, inside biggest audit standard shake-up in a decade. New standards aims to restore trust after high-profile corporate failures. US markets, Monday evening, US was red, S&P down 0.1%, Nasdaq just under 0.33% weaker. Easter's mostly red, Sydney the exception, up 0.33%. Tokyo is closed for Mountain Day. Hong Kong is 0.5% down, Tencent 2.25% weaker. Commodities, green. Gold futures 4,478, Brent 87.83, Platinum 1,771, Palladium 1,392, Rand 16.19, Bitcoin 64,100, and top 40 opening call, a green open 51 points, 0.05% higher.
Moneyweb Now, on the money. Also available on podcast.
Trading now with Bradfield, as I said, portfolio manager at Sharenet. Dylan, appreciate the early morning time. Friday's jobs data out of the US. The unemployment rate actually went from 4.2 to 4.1, but there's T's and C's in that, participation rate, etc. But they were expected to add about 80,000. They lost about 23,000. And of course, that's bad news is good news. The market on Friday rallied quite heavily in the back of it. US markets, our local one as well.
Yeah, I mean, it's that, as you said now, bad news equals good news. Equities rallying, dollar weakening, gold seemed to surge, and that's been really good for all emerging markets, asset allocations. Yeah, going through the numbers, we were looking for a little bit of a boost around. We actually had around 60,000, so the minus 23 print was quite big. Mm-hmm. Big revisions downward as well from May through to July. So it looked like all of the World Cup hiring had fizzled out. On the government side as well, big losses there, over 50,000 jobs. But private sector still growing. Healthcare showed about 22,000, and the private sector still growing 30,000.
What the market liked about it, as I would understand, is the Fed's dual mandate. One is inflation. We know what's happening there. It's going weaker. But the other is jobs. And if we see weakness in jobs, then maybe the Fed doesn't need to raise rates. And hence, as you said, good for equities and I mean, good for gold. I mean, gold suddenly back in the spotlight again.
Yeah, well, the probability of a rate hike went from 50-something% all the way through to 40%. So, yeah, market is now kicking the can down the road, so to speak. That gives us a bit of runway for probably further allocation into equities.
Let's bring it back home. We had also a Spur update. Moving parts here. They have lost, and we know this. This is not new. They've had an adjudication ongoing. They have lost that. They have provision for that. Total of 129.5 million. But if we strip that out, they're looking at a 5 to 13% Heps increase. Now, that's a wide range. I mean, 5% is not a heck of a lot. 13's not bad. But I still got to say, I think it's not a bad number coming out from Spur, because the consumer in the period to June was under the cosh. Our wallets are being squeezed.
Yeah, no, I mean, just look at me as a parent that's now frequently going to Spur. It's a common trend. These Spurs are operating. I think every kid has a rite of passage to have their birthday there. So, yeah, to see the Heps growing double digits on the group revenue, so double digits is fantastic. More importantly, even with the arbitration, they still kicked up their dividend quite significantly. So you've got a high payout ratio there. This is definitely one of those stocks you'd probably want to own, especially for the widows and orphans. But yeah, some slowness down on the John Dory side of their franchise, but once again, just noting some trends of how people are eating. Panarati is up quite nicely, up 17%. So certain types of food are resonating with certain clients.
And they are, and I know Famous Brands has run incredibly hard, but to your point around Widner's offers, I mean, Spur, I mean, no debt in the balance sheet, dividend yield sitting at north of 7%. I mean, this really is a solid little business that survives in good and bad times. I mean, they would boom in good times if they can survive in the tougher times.
Yeah, and still, if you look around, they've added a couple of stores. I think we're just under 30 new stores coming to market. So there's definitely demand for the eating out scenario. Balance sheet remains significantly strong. So I think, there's still optionality for further share buybacks and further dividend growth in years to come.
Yeah, I don't have kids. So I don't eat at Spur, but everyone else does seem to eat there a bunch. We'll leave it there. They're still in Bradfield. He's portfolio manager. Sharenet, I appreciate the early morning time. Our poll today on LinkedIn is about that Spur. People eating out, even if our wallets are being squeezed. I mean, Dylan makes a point. I mean, if you've got kids, maybe it is just sort of like, I don't know, you're between a rock and a hard place. You absolutely are. And maybe we need to look more at the famous brands, particularly their sit down, to get a sense. But have your vote, have your say, LinkedIn. Give your money smoother returns for Stanlib Asset Management. The Stanlib Flexible Income Fund's agile investment process preserves and grows capital in all markets. Think SARS isn't watching? Think again. Join Moneyweb editor Ryk van Niekerk in conversation with SARS Commissioner at the Money Summit. Together they will unpack how SARS has transformed tax collection through AI-powered audits, third-party data matching, and tougher compliance measures. Find out what every taxpayer and business needs to know. Tuesday, 1 September at the Sandton Convention Centre. Register for free using promo code Moneyweb. Visit moneyweb.co.za and secure your seat today.
Moneyweb now on the money.
Chatting with Maarten Ackerman, Chief Economist, CAM Asset Management. Maarten, appreciate the time. If we look at the war happening in Iran, lots of moving parts. But if we kind of step back, I think many, certainly myself included, thought that the economic implication would be a lot more severe, a much worse slowdown economically. It hasn't materialized. I mean, it's not great, but it hasn't been perhaps as bad as it certainly was expected to be.
Yes, morning, Simon. I think you're 100% right. It's obviously impacting different parts of the world slightly differently. And we can go into that in a little bit more detail. But I think the one thing is the world entered this war being fairly strong. We were expecting rate cuts and inflation being under control and all of that things earlier this year. So that helped a little bit. And then I think, if you look underlying, most countries these days can produce more GDP with less oil. So that makes the world a little bit more resilient. And then especially countries like the US, they now a service tech-based economy. They've got strong high-income consumers. They're in fact benefiting from the tension in the Middle East because they're also a net exporter of oil. So all of those factors are making the US very resilient, and we haven't really seen any slowdown there. But unfortunately, that's not the same if you look at some of the other developed markets. So like Europe and the UK that are importers of oil, they are struggling more. So yeah, I think much better than expected. And it tells us a little bit about how the structure of the world economy changed since the Industrial Revolution.
That's a good point. I mean, I want to come to inflation in bits, but let's touch on that where it's benefiting. We are seeing a bit of a K-shaped recovery, much like we saw in the pandemic. But of course, that was internal to economies. This is more global. As you say, US is doing perfectly fine. It's Europe that's struggling. It's Japan, China. I mean, they're still doing good GDP, but they're probably not going to get the 5% that they're targeting.
Yes, so the developed markets that are struggling, like I've said, is more Europe, UK and Japan, basically relying very much on imports. Europe is now importing most of their oil from the US. But it's not only that. They've also got structural issues that's got almost nothing to do with the war. They've got aging populations. They're not that productive. Yeah, shame. Europe is between a rock and a hard place with cheap imports from China and tariffs from the US. So the whole auto industry is going nowhere. Turning to China, yes, they're also reliant on a lot of energy, but they went into this with stockpiles that we haven't seen in many, many years. I don't know if they expected something, but that definitely helped them quite a bit, weathering the storm as well.
Yeah, it's certainly Chinese stockpiles, I think, way more than anyone anticipated. One of the concerns, and we've seen it, we've certainly seen some inflation coming through, but perhaps, again, maybe not as bad, maybe it's still coming, but inflation remains probably one of the key risks that we're looking at, both as South Africa, but as a more broader global economy.
Yeah, so I think, just quickly back to the growth. So I think growth should be okay, given the factors that we've unpacked. So the war is really not going to impact growth that much. But you're 100% right. The economic risk is boiling up in inflation. We've seen that all around the world. Central banks, therefore, mostly are on hold, and it's probably going to remain like that. The concern there, it's not just about the oil price. And, in this environment where it's war on, war off, and then the oil price is up and down the whole time. But even if we get a year from now and oil, let's say, is at the same level, if even lower, then theoretically, your base effect kicks in and inflation from oil should be almost nothing. But what we are worried about is that, it's the secondary impacts that we're seeing. So, for example, the transport cost, which is still up about 6 times compared to where it's been before the war started. That haven't started to decline yet. Fertilizer costs, which will have a major impact on food inflation. And now for South Africa, that's just assuming that we'll get the fertilizer in time to actually have it ready for the summer planting season. I think it was last week where the crop estimate committee said that our crop can be as low as 1929. If that's the case, we are going to see food inflation as well. So long story short, not only SA, globally, we're going to see sticky inflation given these additional logistical issues that's keeping inflation elevated. A lot of ships needing to take the long route around the Cape of Good Hope, which is adding a lot in terms of not only fuel, but also insurance cost. So the inflation picture, unfortunately, I guess probably for the next 18 months is going to be under pressure, which is putting a massive hold in terms of any easier policy. Which is not really great news for consumers that's under pressure.
And that's perhaps the food inflation. And I was reminded, as Wandile Shalobo mentioned it to me, the food that I'm going to eat at my Christmas table's kind of been planted in sort of, March, April, May. It's that lag effect, which is why, to your point, this, although we might see some improvements in some places, it's going to be tough. And of course, that's excluding, we're staring down a potential drought as well.
Yes, no. So if you really want to think about SA agriculture, we're facing a couple of headwinds. We're coming off a very high base, which is never good. To repeat that 17% growth we've seen last year, given the headwinds that we are facing, is almost impossible. We've got the weather patterns, El Nino, which is not great. Yeah. We already had floods in the Western Cape and the Northern Cape, which is impacting, the yield on our nut exports, citrus exports. We spoke about the fertilizer. That's an issue, the input costs in terms of diesel, foot and mouth disease. So you get the pictures. So that all means that, food inflation is almost going to be a reality.
We'll leave it there. It's Maarten Ackerman, Chief Economist, CAM Asset Management. Appreciate the time. Let your money weather the storms with Stanlib Asset Management. Invest in the Stanlib Global Select Fund, a diversified all-weather equity portfolio submanaged by JP Morgan Asset Management.
Moneyweb now on the money.
Chatting now with Duma Mxenge. He is Head of Business Market Development at Satrix. Duma, always appreciate the early morning time. An enjoyable read you had out recently talking around avoiding in a sense, it's avoiding the FOMO trade and actually understanding what is in the ETFs that you are buying. Sort of doing the homework and kicking the tires in a sense.
Morning, Simon. Yes, we also thought it was quite an interesting article that we put out, and I think it was also kind of sparked by the idea of the famous buy, so where you're there and people are basically sharing their investment ideas and then you go away without actually even thinking, you just invest, blindly. So we were basically just saying, want to actually hit some bit of caution around that.
And it is. And I mean, I think it's understanding what's there. And I think a great example, towards the end of last year, lots of talk around emerging markets. They did really well for much of this year. But of course, it really wasn't around emerging markets. It was around South Korea. It wasn't even around South Korea. It was basically two memory stocks. SK Hynix and Samsung. And it goes back to understanding what's in that ETF and what you're really getting. And I suppose what you're really trying to achieve.
That is correct. And then we basically are saying that, when you are doing your homework, you need to think about the bigger picture. And there are two parts to it. One is to understand or identify the exposure. You've just made a great example around the emerging market ETF in terms of what's driving the returns. It's understanding the underlying markets, or understanding the index, or understanding the asset class if you're looking at maybe a more diversified, type of strategy. So that's one part. The other part is, what's the purpose of you actually being invested in this particular ETF? Is it for growth purposes? Is it for income return? Or is it for diversification within a broader portfolio? So that's what we are saying you must actually think about when you're actually thinking about being invested.
It comes back to, I suppose, that is in essence the old school way of doing it. And it is a case of, careful of chasing winners. You talked around that standing around the braai, you talk around the sort of FOMO trade. It's avoiding that chasing of the winners and getting balance right. And the first part's perhaps easier. The balance is perhaps the harder part in many cases.
It is. No, it is. I do agree, as you know, and I think Warren Buffett also famously say this, is that, the only thing that you can get right in investment that you have control over is diversification.
Mm-hmm.
So, and we are saying that even within diversification, you must actually also look at what you invested in. For example, if you invest in an ETF that's heavily weighted around, let's say, tech stock, essentially what you're not well diversified. You actually have great exposure in one particular sector. So you need to think about sector exposure. You need to think about country exposure. You also need to think about market exposure. So those are the things, we really are encouraging people to think about.
And that's a great point. I actually was doing over the weekend, I was doing some digging. We look, the S&P 500, you mentioned tech.
Yeah.
That's almost 38% tech and what, 41% into the top 10. You go to just the MSCI, the All-World Country Index, suddenly your tech's at 30, your top 10 is at 24. We're getting technical here, but it is a sense of that wider spread.
It is. And that also brings opportunities elsewhere. From investors that we have spoken to, but even as early as last year, is that there was concern around the massive exposure or great exposure into the US, and the conversation we've been had to say, where else, can you find, value in terms of being invested? Europe is one, Japan is another area. I know right now, EM is running. But that's the kind of thing you need to think about. It's not necessarily to say, where are you going to get your growth? It's more thinking along the lines of how to be well exposed in terms of your exposure, in terms of your overall portfolio.
But I like your thinking there. What you're essentially saying, EM's running. So what you're sort of running away from EM and saying, well, if EMs are running, where isn't it running? Because I'm going to get slightly better value there in terms of potential over the, if we're investing for 5, 10, 20 years, the EM running today, that might not be a story in the longer term.
No, absolutely. But I just want to make it clear. If you are invested in EM right now, we're not saying sell your EM exposure and go elsewhere. We're just saying that for your new money, perhaps start digging and looking at other opportunities elsewhere.
Yeah, but look, to be clear, I'm holding that EM ETF and I'm happy with it. But I like your logic there. It's a case of perhaps it's a great way to sort of manage exposure. Is that what's currently sitting in your portfolio? As long as it's well constructed and put together, you can kind of let that do what it is. It's the allocation of new cash where we can be clever.
Absolutely, and it's about valuation, right?
Yeah.
So right now we are saying don't actually go for an exposure or an ETF that's actually doing well. You should actually be looking where ETFs that gives you exposure where the valuation is actually quite attractive. That's what we're actually trying to drive home.
Yeah. Fund the value, don't fund the hype. I suppose that is it. We leave it there. Duma Mxenge, he is Head of Business and Market Development, Satrix. Always appreciate the early morning time. That's it for today. All the way back on Friday, we've been chatting with Deshaun Chetty from Ford Asset Management. We're talking the state of the SA consumer after 7 years of negative confidence and how that has changed shopper patterns. I always say consumers are smart. We shop around the problems, but it does mean that the retailers need to adapt. We asked, has your shopping changed over the last few years? Over half said absolutely yes. Third said a little bit. The rest said not really. Have your vote. Have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning. The Moneyweb website and the app, 6:30 a.m. Podcast just after 7. Thanks to my team, Eddie Noboklet, Nicole Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. If you're loving the show, please leave us a positive rating and an awesome review in your podcatcher of choice. We'll chat again tomorrow. Resilience, not cost-cutting, is the competitive edge.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.